keep more of what you earn, real-life examples of highly effective tax strategies. We've all heard from our accountants and from our financial planners what we should be doing and what the options are available, but I think it makes it a lot, and it will become a lot more impactful if I show you some of the real-life examples that we have done here at Schwaben. Introduction to Schwaben. I established Schwaben with Martin Häfele in 2010 to service a unique need for high net worth individuals and their wealth, to offer more exclusive investment management and client service experience. And what we provide is investment and wealth management, corporate and finance and advisory to owners, estate planning, executorship, and insurance, and also family office services.
We're not seeing that screen. We're still seeing that.
You see? Oh, sorry, I think I had a bit too fast. I think we're now. You see that? So introduction to Schwaben. Just as I pointed out, we established in 2010 to give clients a better experience. Meet the team. It's myself. I've been in the business for over 30 years. I started with some of the larger firms, worked for a few boutique firms, and ran a private family office before starting my own firm. Martin Häfele joined me in 2010 when we started the firm. He's a successful entrepreneur and a partner at Häfele SE Co. KG. It's a family business that has a furniture and architectural hardware business with an office in 40 locations worldwide. He is an expert in ultra high net worth estate and financial planning and family conflict resolutions from his own personal experience. Hamza is our third edition. Hamza joined us about a year ago. He's Vice President Associate Portfolio Manager. He was formerly a research analyst in the Far East, and also worked as an investment banking associate in the Middle East. He's got global work and educational background and really fits very well in with our team. The presentation outline. What is our aim and our purpose? Really, as I pointed out before, we'd like to show you case studies of effective tax strategies. And once you see some of the numbers and how people are benefiting, it will likely have a bigger impact in how you may perceive some of those strategies. We want to raise awareness of effective strategies and quantify them. We want to show you real scenarios, the tax circumstances, and how effective they are. And you may refer to your accountant for additional strategies that we can utilize. But we've always found that oftentimes we've shown the accountants what strategies worked well for our clients, and we've often got a thumbs up from them. What we hope you take it away from there is that accountants are really backward-looking, not forward-looking, and hence we would encourage you to explore the various strategies that we show you, and discuss them with your accountant if you feel that they relate to you. And we'd like you to relate to any situation present in order to gauge whether these strategies apply to you. Table of content. Our first case study is about Ross Zimmer. He is a real client. However, we've changed the name of the individual to protect his identity and for confidentiality reasons. Case number one, we'll talk about RSP, we'll talk about TFSA, income splitting, a prescribed rate loan. Then we'll go into Eugene Baker, who is our second client, Canadian death taxes, liability matching with insurance, trusts, and then we'll have a number of other examples and strategies how you can save taxes. So let's start with Ross Zimmer. Ross Zimmer is a 62-year-old executive. He's a director, an executive search firm. His current annual income is $400,000. He's got a $150,000 vacation property He's got a $1.25 million home. His car is not too expensive. It's $15,000. He lives a fairly, he saves, and he has a family. His liability, he's got a $350,000 mortgage. However, he's got a $500,000 unused RSP room that he has never contributed to, because in his earlier years, he didn't have sufficient income to cover RSP contribution along with supporting the family. And later on, I guess he was never really was never brought to his attention the benefit of his unused RSP room. Ross has recently entered his highest income tax bracket. He's now making $400,000, which will likely go up over the next couple of years. He's paid for his kids' tuition. He's paid down most of his home. And Ross has put a small amount aside in an RSP. However, there's still $500,000 available. And Ross plans to start his own business in about 3 years after he retires. The issue to address here is, how can we maximize the net wealth in light of his low savings and retirement expected to be in 8 years, and that he's in the highest marginal tax bracket. The topics that we're covering here is the RSP, the TFSA, and income splitting. Now, I'm sure some of that will resonate with you. A lot of people haven't contributed to their RSP, and they may still have additional RSP room available. So I think this example will show you how powerful it may be to use that strategy to make additional savings. What we've done here is Ross Zimmer to get refunds through his RSP and invest them. His RSP payments are up to an annual limit deducted from income, and they grow tax-free. The contribution room that you've saved from the beginning when you first got your first job can be carried forward and can be used. That is where Ross's $500,000 unused RSP contribution comes from. It's built up to that by the year 2020. The RSP, you get a deduction based on your marginal tax rate. So Ross making $400,000 a year is at a 53.5% marginal tax rate, and he is in that tax rate for the top $180,000. So the higher the tax rate, the higher the savings. Ross has had a negative attitude towards RSP because he realized he had to pay taxes at the end. What Ross may have not realized is that when he takes money out, it will be a different tax rate than what he can deduct. So he literally gets a tax gift from the government. So when we take a look at this, and we've basically taken it from 62 until 71, when he has to convert his RSP into a RIF. So at 62, we've specified $400,000. As I said, the top $180,000 will be taxed at a 53.53 marginal tax rate. So best to contribute the first $180,000 at that and get a tax reduction of 53.5%. That leaves him with a net income, net taxable income of $220,000. The tax that he would have paid without an RSP contribution would have been $170,000. The tax that he pays with an RSP contribution, he will pay $80,000. So a $90,000 saving, almost $92,000 saving. His average tax rate before the contribution would have been 42%. Average tax rate after the contribution is less than 20%. Of course, it's on an RSP, the money and the funds that he saved. However, he saved 22% taxes, and those 22% taxes went directly into his savings in the RSP. What we've done is, in order to portray and show you what the benefit is, we've escalated his income by 5% every year, and his RSP contribution we've maximized until he's used up all the benefits. So when you take a look at 64, he's making another $206,000 contribution, and at 65, he's actually used up his entire unused RSP contribution room. So he's taken full advantage of all the RSP savings. As we had indicated, he's planning on starting his own business after retirement. Ross doesn't expect to have an expensive lifestyle, so he expects that him and his wife will likely need $75,000. By that time, all the children will be out of the house, they will have their own careers, and they will be on their own. So $75,000 will be sufficient. This is where the income splitting will come in. And what we've done with Ross, we've set up two RSPs, one for himself and one spousal RSP. So this spousal RSP, how this works is Ross can basically contribute to this spousal RSP based on his available RSP contribution room, but attributed to his wife. So we set up a second account. It's called the spousal RSP, and they both get the same amount. So out of all the contributions that we've made, we've split that into two, one to Ross and one to his wife. At 66 and 67, as I said, they expect that they need about $75,000 income together. So each one of them will draw $37,500 income. That will mean he's going to pay, each one of them are going to pay $7,500 in taxes, or 20%. If you can see, we've made the contribution when his top marginal tax rate is 53.5%, and now he's taking it out at 20% tax. So that means we've literally got a 33% gift from the government, because we've put it into an RSP and we're taking it out now at a lower tax rate. So the first 2 years, we expect that he's not going to draw anything from the business. In the third year, he's likely going to make $180,000. Or that's what he's going to take out of the business. By that time, he will have hired his staff, he will have established his business, and he's going to start making contributions again. As pointed out before, he's used his entire carry forward RSP contribution room before, but now he still has an RSP contribution that will accumulate on an annual basis. So he's going to make another $31,000 RSP contribution. Tax without the RSP contribution would have been $60,000. Tax with the RSP contribution is $46,000. There he's saving another 8% in his RSP contribution. In the business, in 69, is going to get another $32,000. When he's 70, another $34,000. And at 71, he'll make his final contribution of $35,000. In each case, he's going to save taxes. By utilizing his RSP contribution through debt and equity, Ross has gotten a $380,000 tax deduction, which is more than half of what he's actually contributed to it. That came directly from his taxes. So what I would like to ask everyone at this point is, we're going to do another poll, and I would like to ask you if you regularly contribute to your RSP given the savings that you get. Let me start the poll right now and see what everybody's feedback is. Give everybody a few more seconds, and then we'll show you the votes. So So far it looks like most people are making their RSP contribution, and which is good. So I think this demonstrates that a lot of people are still very tax efficient, or making sure that they're planning properly. Okay, let me show everybody what the results are. The results, yes, 84% of our attendees are making an RSP contribution, which are government gift. Now, one doesn't seem to believe, 5% don't believe and seem to believe in it, and 10% appear to be impartial. So this is very good. I'm very glad to hear this. A study has actually shown that about 50% of people do not really believe in RSPs and have not taken advantage of RSPs. And out of this 50% that have not, 50 are using other tax strategies. I'm glad to see that most people on our webinar are taking advantage of the RSP contribution. So we'll go back. So I think I've demonstrated the benefit that it has given Ross to take advantage of his RSP contribution. Now, the second one is our TFSA, the tax-free savings account. Initially, it was $5,000 and was $5,000 each year. So initially, it was for a number of people, perhaps more of a nuisance than anything else. However, it's the same thing as with the RSP. It started in 2009. The TFSA, you do not get a tax deduction. However, you don't have to pay any taxes when you take the money out. So there is definitely a tax benefit. You accrue your capital gains, your interest, and your dividends, any income that you have on a tax-free basis. So it's a lot more flexible. And given that we're now in the 12th year of the TFSA, there's a significant amount of money that we've now accrued that we can contribute to a TFSA. The benefit on the TFSA is the sooner you started it, the greater your benefit, because everything that you earned in there was earned on a tax-free basis. Now so when we take a look at Ross and his wife, they would have each accrued $69,500, almost $70,000 in RSP contribution room. So it's money that they cannot deduct from the taxes. However, it will accrue tax-free. Together, that's $140,000. The one thing that is very important, even though the TFSA is flexible and you can take money out, but once you've taken money out of the TFSA, you cannot put it back in. You can only make your annual contributions. So make sure that you try to keep your TFSA as untouched as possible, because whatever is in there will accrue and will earn money tax-free. To illustrate what that would mean for Ross, who is now 62, and his wife, when Ross is 85, the $139,000 that he would have contributed today, and he can contribute further as we go along, but the $139,000 that he contributes today would become $816,000 at an 8% return versus only $530,000 if it was not in a tax sheltered account. So you can see there's a very big benefit and big difference. The third item is income splitting. We've shown you before income splitting with Ross, and I'm sure you may have looked at those strategies yourself as well. I don't know if all of you have used spousal RSP or if it was really applicable. The spousal RSP is really beneficial if one of the spouses has a significantly higher income than the other, and they want to contribute and they want to reduce their taxes on their post-retirement years. So Ross starts his own business at 65. We've seen what the tax effectiveness was of his spousal RSP and of contributing to the RSP while he was in the top marginal tax bracket. He saved 33% on taxes by utilizing the spousal and by utilizing the RSP contributions, and also got further savings by splitting those contributions into two individual people. It's a perfect scenario where one spouse stays at home. So if a married couple has children and the wife wants to stay at home for a number of years in order to take advantage of the educational aspect, it's a great method to be able to save taxes, to contribute to both income, and then afterwards split the income when after retirement. Ross expects to be profitable in year 3. So the 2 years that he's not that he hasn't drawn any money from the income because he wants to build the business, he's basically drawn $37,500 out of his RSP and out of the spousal RSP from his wife. On an overall basis, the income split average tax rate was reduced from about 20%, which would have been if it was only his RSP, down to 13%. So it really reduced the taxes down to about 65% of where he would have saved in. That would have been another 35% tax saving. The other option is income splitting through an investment loan. Ross can also pay and lend his wife money. And by him lending his wife money at a nominal interest rate, now it has to be a real prescribed loan rate, so he has to charge his wife 2 or 3%. If she then turns around and invests those assets in a non-taxable account, she's going to earn the income, but she's going to pay him 2 or 3%, and thereby she's going to earn more than what she's paying him, and because the earnings are in her hands, she will be taxed at a lower rate. Effectively, an investment return will be taxed at a lower rate, and she will pay the interest on the loan. The case number 2 is Eugene Baker. Eugene is 52. She's a dentist and a philanthropist. Her current annual income from her dentistry practice and from her family business, where she inherited 25%, is about $5 million. Her total net worth is about $80 million. She's a member of 4 children that have inherited a family business. Not all 4 children are part of the business or are actively involved in the business. The business is worth about $300 million. She has personal assets of another $5 million besides the $75 million business interest. Now, the challenge is, how can Eugene pay the taxes upon her death when she leaves her business interest to her children? If she were to die today, the capital gains tax may be as high as $15 million. Eugene doesn't have that much money, that much cash saved up. So the other challenge is that the shareholder agreement of the family business stipulates that the shares have to be sold to other family members, and they have to be sold at a pre-specified rates, so not at market rates. So what would happen if she were to die today? There would not be enough funds, nor would she be able to sell the shares at a reasonable market rate in order to pay the taxes. In the worst case, if the other family members don't have the taxes and they have to borrow, there may be an additional discount that she may have to take upon the sale of her shares. So how can she fund the tax liabilities by her children or by her children when she dies? The estate wouldn't have enough cash? No. Does she have enough cash? No. Do the children have enough cash? Basically, tax liability at this point would be about $15 million. So the challenges of funding liability at an unspecified time and amount. The topics that we're going to cover here is the taxes at death in Canada, life insurance to meet large post-death liabilities. You already have been, you're now aware of the liabilities that we're talking about. And then we're also going to talk about some income generating trusts that are tax sheltered. So let's analyze Eugene's situation. In Canada, we don't have an estate tax. However, we have capital gains tax. We have capital gains tax. We have provincial probate tax. And if Eugene has any assets in the US, there's going to be US estate taxes. So let's review all those three items. The capital gains tax, upon her death, she will be taxed at 50% of the regular taxable marginal tax rate that she will be in. Given the size of her assets, the top marginal tax rate will be 53.53%, or the tax that she will be liable for, or the estate will be liable for, will be 26.75%. Now there's a tip. If she wants to protect herself, that the assets will continue to grow, she can also set up a spousal trust, or she can set up various other trusts. If she sets up a spousal trust, it will still trigger a tax liability. And the tax liability will be triggered when she sets up the trust, because as soon as the assets will move into the trust, there will be a deemed disposition to the trust, and she will have to pay taxes on the capital gains that she has from the time that she inherited the assets until they go into the trust. The other component is that any registered assets, meaning RSPs, TFSA, or whatever it may be, she can specify a beneficiary, which will then transfer the assets to the beneficiary. Now, she will only be able to transfer those tax-free to her spouse. Unless the children are still dependent, then she can also transfer the assets to the dependent children. However, those assets would have to be invested into a term annuity that will be paid out by the time they're 18. Provincial probate taxes. Everybody has to pay them, unless you give the assets away before, you put the assets in a trust, or you set up some other strategy whereby you can circumvent probate fees. The other strategy, again, the registered assets, if they have a beneficiary and they flow through to the spouse, there's no probate to be paid. Probate taxes are not drastic, but they're still 1.5%, and these are 1.5% that you can save if we properly plan for the day that you pass on. So the tips that I would give to people, that they gift some of their assets while they're still alive, and they ensure that the designated beneficiaries on the investments. So that can be either in real estate, or it can be on investment accounts. When you set up an investment account as a joint asset or a joint account, make sure it's a joint account with right to survivorship, because in that case, the assets will automatically go to the joint individual with whom you've set up the account. In most cases, it's a spouse. And as I said, make sure that you own a proper jointly, so that it flows through tax-free and without going through probate. US estate taxes, that's another issue. Now, in Eugene's case, that is going to be a big threat, because her net worth is about $75 million. Now, the rules for US estate taxes is if the asset that you have in the U.S. less than $60,000, you will be exempt from having to file, or you'll be exempt from having to pay any taxes due to the unified credit relief. The second component is the Canada and US also have a tax treaty exemption. And that means that if your assets are less than $11.5 million, you will receive a tax credit from the US, from the IRS, that is equivalent or higher than what your taxes, than what the state taxes are that you owe to the US. So those are definitely big issues. So in other words, if your US assets are less than $60,000, or if your estate is less than $11.5 million, you don't have to pay US estate taxes. However, this may be changed through Biden. When Biden will start his tax revision, he may lower those amounts. He may eliminate the unified credit relief, and he may also lower the tax treaty exemption available, where you get tax credits. So that may go down to $6 million. We don't know yet what the outcome will be on that. Some of the tips how you can deal with U.S. estate and with U.S. assets. If you have non-real estate assets, put them in a Canadian holding company. If they're in a Canadian holding company, there's not going to be any estate taxes, because a Canadian holding company does not have and it does not have a date of death. So it's a separate taxpayer, and there would be no estate taxes. If you hold real estate, you want to make sure you put that either in a holding company or in a trust, preferably in a trust. Real estate is a more difficult issue than regular stock investments. You can reduce your value of your U.S. assets before you die. So you sell before you die. Obviously, we don't know when we're going to die, but if we become terminally ill, that may be a very good time that it's good to get someone's affairs in order and sell the U.S. State assets. I have a client who has still goes to the U.S. He's had quite a bit of U.S. assets before he passed away, but before he passed away, he had a number of years before, instead of owning the property that he would vacation in the U.S., he would rent it. So he had a long-term rent, and he still enjoyed his stay in the U.S. However, he didn't have any U.S. assets anymore, and thereby was not subject to U.S. estate taxes. If you hold Canadian mutual funds with U.S. Securities, you're not taxable either. You're not subject to estate taxes. And then last but not least, if you know you're going to have U.S. estate taxes, make sure that you have a life insurance policy that will take care of it when the time comes that you pass on. So addressing the largest risk with Eugene is a risk of illiquidity of private shares. The estate liability of capital gains cannot be funded. Early death due to accident or illness will prevent the estate or the children to pay the taxes without liquidating those shares. If she was to be assured that she will live until 80, 85, she could put enough money aside that will pay for the estate taxes. However, she doesn't know. We don't know when we're going to die. That's the biggest risk. So the capital gains payable would arise in Eugene's portion would be as high as 15, 20, perhaps even $25 million, because as the business grows, her capital gains on their shares of that business will continue to grow, and so will be her taxes. The life insurance policy can offset capital gains taxes at premature death. That's really the biggest point that we're trying to make here. Estate and tax planning using trusts. So in a trust, there's a settlor, there's a trustee, and there's a trust, and there's a beneficiaries. So the settlor transfer the ownership of the property to the trust. The trustee is the one that will be in charge of the assets in the trust. Then there's a trust itself, which holds the properties, and then there's a beneficiaries. In many cases, the beneficiaries is either a spouse or it's a children. Now, unlike a simple will or gift, trusts can issue the asset control protection and tax reduction. Trusts are treated just like a separate taxpayer. Trusts, in many cases, are taxed at the top marginal tax rate. That's obviously a drawback, but it's a small drawback compared to what the taxes would be otherwise. The income is not distributed to the beneficiaries, and however, as I indicated, is typically taxed at the top marginal tax rate. The trusts require assets at fair market value and deemed disposition. So when you decide that you want to set up a trust, make sure that you're aware of the capital gains that you have to pay when you actually set up the trust and when you move the assets into the trust, because there will be a tax liability. But the tax liability will likely be a lot less than if you don't set up a trust and the beneficiaries have to pay the taxes at the end. We also don't know what the taxes will be when you finally pass on. So if tax rates go up, you would be subject to a higher tax rate even. The other types of assets, the types of trusts that you can use are alter ego or joint partner trusts, which allows you to avoid probate. And then there's qualifying spousal trusts. Qualifying spousal trusts are a great method of transferring your assets to a spouse and to children if you've had more than one, if you've been married more than once. So if you've had children from your first marriage and you now have your second spouse and you want to leave for your second spouse a certain number of assets, and you also want to make sure that your children will get get assets as well, you could set up a qualifying spousal trust where you give perhaps 50% of your assets to your spouse and the other 50% to your children. So it would be specified in that trust and it would flow tax-free through. The other useful trusts are inter vivo trusts, which is also an estate freeze. Those are very oftentimes used when you have a business and the business is in your hands and you know that your children want to take over the business, and hence you want to make sure that whatever it grows, whatever the company grows, it will not accrue onto your capital gains when you die, because you most likely will die before your children, but that those taxes or the capital gains will accrue in your children's hands. So what happens is, in an inter vivos trust, as an estate freeze, you keep preferred shares, you keep control of the corporation through the inter vivo trust, and the common shares will go into the trust for your children. And your children, once you pass on, will automatically get the trust, the assets out of the trust will be released and will be in the hands of your children. So hence, they will not accrue, they won't accrue any further capital gains, or you won't accrue any further capital gains from the time that you've set up the inter vivo trust until the time that you pass away. All those capital gains will have been accrued by your children or by the trust, and hence your estate, or not your estate tax, your capital gains tax at death will be significantly lower. Other strategies that we have. Hold on for a second. I don't know what happened here. Let me just. We seem to have some technology issues here. Let me quickly see if I can rectify them. I'm sorry, I don't think, I'm not sure if we can try this again. No. Other strategies, since I'm sorry, I don't seem to be able to get those strategies up right now, not on the presentation. I will be forwarding you the presentation and also recording of our presentations, of the presentation that we have, and you will be able to see them on the presentation. Other strategies for reducing taxes is charitable donations. It's also, let me just quickly go back here. It's charitable donations. You can also set up RSPs. Let me just, my apologies that this has happened. So charitable donations is big tax saving strategies. We've set up a foundation for one of our clients who sold this business. So he got a tax credit of 30 to 40% of the amount that he put into the donation. So it allows you to give more away in the form of charitable donations on an annual basis when you set that up, and you get your tax credit right at the time when you set up the foundation. And oftentimes when you sell your share or when you sell your business, this is normally the best time to set up your tax strategy. The principal residence exemption is also a very good methodology. Another one of my clients purchased a home in Thornhill in 1981 for $175,000, and they sold it in 2016 for $2.6 million. That's a capital gain of more than $2.4 million. They would have been taxed at a tax rate at a rate of about $600,000. They saved $600,000 in taxes just by the mere fact that it was a principal residence and that the principal residence was not taxable. RSPs is another strategy. It's not a significant one, but it helps you to help your children save for their education. So it stands for Registered Education Savings Plans. For every child that you have or grandchild, you can make an RSP contribution of $2,000 every year, and you get another $500 from the government for every $2,000 contribution that you make through the Canadian Education Savings Grant. And you can also get additional funding from the Canada Learning Bond in the amount of $500 initially and $100 every other year. So it's a small amount, but if you have 4 or 6 children, all of a sudden there's quite a bit of money that you can make, and you make an instant 20-25% return because you get a grant from the government. And last but not least is the flow-through shares. Flow-through shares are an interesting structure. It allows you to achieve your returns either by capital gains or by return of capital. If you get your returns by return of capital, you pay literally no taxes at all on your returns. The way they achieve that is through a number of swaps and structures in the background. They take all the earnings and they use their expenses that they have operationally, and they offset those expenses, the interest or the income that they have in some of the mutual funds against the expenses. And by doing so, they can swap the return, the type of the return, from one mutual fund to another mutual fund. So those are called corporate class mutual funds, and they allow you to defer your taxes. The last one is a flow-through shares. Flow-through shares is somewhat of an unusual structure, and it definitely has a significant amount of risk. Flow-through shares, really what it does, it exists in the mining business, in the oil and gas business, and the film industries. They take the expenses that they incur through drilling, through exploration, or in the case of movies, of producing the movies, and they sell those expenses through a limited partnership to the investors. The investors get to write off the expenses. However, in return, either get shares or participate in the revenue stream of movies. The challenge in many cases in many of those cases, they're risky investments. Sometimes the assets or the exploration expenses are not spent properly and may not yield much return at the end. So before you get into flow-through flow-through shares or flow-through limited partnerships, make sure you understand the business, make sure you know management, make sure you've done your homework, and make sure that the investment is a solid investment. Because otherwise, the write-off is literally all it is that you're gonna get. You're gonna get the write-off, but you're gonna get no return. So make sure that the investment is good before you enter into this. So these were all our questions. Let me quickly return, and I'll show you quickly show you our contact information. 1 second. We seem to have technology issues again today. This is unfortunate. However, as I said, our information, we will be sending you all our presentation and a recording of our presentation, and it will have our contact information and our email addresses. You may contact me directly. My telephone number is 416-477-7216. Or Hamza's telephone number, if I'm not available, is 416-477-7217, and the email addresses will be part of the presentation as well.